Hi, my name is Paul, and welcome to episode 19 of my monthly stock portfolio series, where I invest $100 of my own money each month into Canadian securities. In this month's episode, I'll just be going through some of the relevant news and covering how my portfolio performed during the month of June. And as always, I'll be showing you exactly where I'm going to be investing this month's $100. But really quickly, before we get into the video, please be aware that there is a link in the description box to the goals and rules that I've set out for investing within my monthly portfolio. But if you happen to be somebody who prefers watching videos to reading, then you can also watch me go through everything in the first episode of the series. And a link to the playlist starting at episode 1 is also available in the description box of this video. Now on to the news. And as has been pretty typical lately, there wasn't much big news to come out regarding any of the portfolio's holdings. But there were at least a few minor things worth covering. First off, we had the Morguard North American Residential REIT announcing that they'll be releasing their second quarter financial results on July 25th, and that they'll be hosting their conference call on the 27th. And this is definitely one that I'm looking forward to, since we'll be getting an update on share repurchases, and Morguard's share prices were quite low throughout the month. So I'm excited at the prospect of possibly getting to see some information about the buyback program subsequent to the quarter's end. That said, I may not make a dedicated video on this earnings release if there aren't any other events that take place over the quarter. And I think that's probably how it's going to play out. Anyways, while I'm on the topic of buybacks, MTY Food Group also announced that they'll be renewing their normal course issuer bid for another year. And unsurprisingly, they didn't repurchase any shares under the previous NCIB, which is probably a good thing considering the current size of the debt load. Though, share prices for MTY have also been very reasonable lately, in my opinion. That said, we should be getting a lot more insight into the progress that's being made on grinding away at that debt pile, as well as how the newly acquired restaurant brands have been progressing, because MTY will also be releasing their second quarter results and conference call on July the 11th. And this is an earnings report that I'll definitely be covering in a dedicated video because there are so many ongoing questions that we'll be getting answers or at least updates to. So you can expect that video to be out by Tuesday the 18th at the absolute latest, unless something catastrophic happens. And with that, we can move on to how each stock performed this month, since there wasn't so much as a peep out of GoEasy. The best performing stock this month was the Morguard North American Residential REIT, and at the start of last month, I purchased 4 shares for $16.92 each. Now, Morguard's share price actually ended the month slightly lower at $16.75, which would have been a loss of about 1% or 17 cents per share. But thanks to the monthly dividend, on behalf of Morguard, I received $4.32 in distributions, which turned that 1% loss into a 5.37% gain. The next best performer was MTY Food Group, and last month I bought 0.64 shares at a cost basis of $58.69 per whole share. Throughout the month of June, MTY's share price rose to $60.84, notching a 1-month gain of 3.66%, or $1.37. And the portfolio did not receive any dividends from MTY in June. Last up, we have GoEasy, which I actually didn't buy any shares of last month. Nonetheless, the share price at the start of the month was $108.21, and the shares ended the month up 3.48%, or $3.76, resulting in a closing price of $111.97. And like MTY, GoEasy did not pay its quarterly dividend this month. So, with all of the holdings increasing, the 1-month results for the whole portfolio were of course positive, putting up a gain of 4.77% when including the dividends earned, or about 0.66% if we exclude the $4.32 in received dividends. Now, once again, in this month, none of the benchmarks received any dividends, which allowed my portfolio to outperform the rest of the group. But if we factor out the earned dividends, the Global Value ETF led the pack with a gain of 2.43%, and it was closely followed by the S&P 500, which put up a gain of 2.39%. My portfolio would have been next, and then we have the two Canadian ETFs, the large cap and the all cap, and they declined by 1.06% and 0.89% respectively. All in all, my portfolio performed reasonably well this month, and it's nice to see that we're continuing to outperform the Canadian benchmarks. But we've still got a long way to catch up to where I'd like the portfolio to be at. See, if we take a look at the total portfolio performance, from the start of the series in January 2022 up until the market close on July 6th, 2023, so far I've invested $1,837.11 in personally contributed capital and dividends. But as of the market's close, the value of my portfolio is now sitting at $1,822.93. This means that so far the portfolio is in the red by $14.18, or 0.77%. Now, this is at least an improvement over last month when the portfolio was sitting on a $44 loss, but I still have a bit to go in order to break even on those reinvested dividends, let alone pull ahead of my annual goal of earning 12% per year. On this graph here, the green line represents my portfolio's performance net of contributed capital, which is just a fancy way of saying that it's tracking the current profit or loss that's been made on the money that I've personally put into my monthly investment account. Meanwhile, the red line with the X's is where my portfolio should be if I were keeping up with my annualized goal. So you can pretty clearly see that I'm still off by more than $100, though June was definitely a step in the right direction. On the other hand, the S&P 500 has really been pulling ahead, and it's the only portfolio to have reached above the goal line since the end of February of this year. This should illustrate that you can definitely get good returns by passively investing in index funds that mimic the market. In fact, based on where things stand, I might just be better off investing in the S&P 500. But I'm not going to do that because I'm very confident that I've invested in heavily discounted securities that will very likely go on to outperform the broader market. It'll just take a little bit of time for things to come to fruition. Plus, it's very easy to fall into the trap of recency bias. After all, there have been several points in the past where it looked like the S&P was an inferior investment. But given how large the swings have been within all of the portfolios over a period of just a few months, it's way too early to conclude whether or not the S&P truly is the best portfolio out of the bunch. In the meantime, I'm just going to keep focusing on putting my money where I've done the research enough to feel confident that I will get a very good return on my invested capital. So, what does that look like for this month's $100 of added cash and $4.32 of dividends? Well, last month I said that Go Easy was a bit too expensive for me, and the only thing that has changed since is that the price has gone even higher, so that one's definitely out of the question. Morguard, on the other hand, has dipped a little bit further, and I'm expecting them to report that they've repurchased a good number of shares once their quarterly report comes out next month. And I think that this is going to be a significant factor for driving share price up over time. So I'm actually going to be buying 5 shares of Morguard this month, though I do wish I was getting them in the high $15 range where the shares were trading at a week or so ago. Anyway, the rest of the money will be invested into a fractional share of MTY Food Group. So let me hop into the Wealthsimple account and I will start the buying. Okay, it's about 1:44 on Friday the 7th, and we have exactly $104.32. So I'm going to buy 5 shares of Morguard. And then really quickly, I'm going to put the rest of the money into MTY. All right, and I'll see you back when that comes through. Okay, I've just received an email confirming my purchase of 5 shares of the Morguard North American Residential REIT for $16.80 each, and also 0.326 shares of MTY Food Group at a cost basis of $62.40 per whole share. And after these orders were filled, my portfolio was left holding no cash at all. So, as of the market's close on Friday, July the 7th, my portfolio holds 81 shares of Morguard worth about $1,357, about 6.31 shares of MTY Food Group worth approximately $388, and the same 1.62 shares of GoEasy worth nearly $183. And there is no cash currently being held. Moving on to the dividend tracking segment, only Morguard paid a dividend during the month of June, and it distributed a total of $4.32, which is quite a ways away from affording financial freedom. However, it is enough to buy this unreviewed generic USB fan that will hopefully help to beat the heat, assuming that it actually works. Though the dividends definitely won't be able to pay for the shipping costs, but such is life. Besides, in terms of collecting dividends, we've been on a roll lately, and the last thing that I want to see is for that to cool off. See, since inception, the portfolio has now earned more than $41 in total dividends. And in the first half of this year, we've already received nearly $25, which equates to a quarter of the amount of money that I would normally put into my Wealthsimple account each month. And as the months go on, that amount will only continue to grow. For instance, next month, the portfolio is expected to set a new record for dividends earned in 1 month, coming in at $6.12, which is almost a full dollar higher than the previous record of $5.17 set in May. This record dividend will be received in 2 payments, the first being Morguard's monthly distribution, which is expected to yield $4.56, and the remaining $1.56 will be paid out by GoEasy. Now, if I were to just leave the portfolio as it is and collect the dividends in cash for the next 12 months, assuming no changes were made, I would expect to receive $70.68, which is a 5.87% increase from last month. This moved up my yield on contributed capital by 1 basis point to 3.73%, which is actually quite high considering that I'm not at all focused on attaining high-yielding stocks. It just so happens that the best deals that I've been able to find happen to be in companies that are offering very strong dividend yields. But again, it's not what I'm focused on, it just happens to be that way. Anyways, that's all the time that I have for this episode. Really quickly though, before you leave, please remember that this video is not financial advice and that I am not a financial advisor. This video is made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I am not a financial advisor, I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who may also benefit from it. Thanks for watching all the way to the end, and enjoy the rest of your day.